except that each year you have to pay a premium, and it's like $105 per participant. And then if you're underfunded, then you have another variable premium that depends on how underfunded you are. So each year, even if you have enough money to pay out the benefits, if you've got 50 participants, you're going to have an extra $5,000 premium going to them that you don't really get any credit for. It's just one of those added costs of having the plan. Even though you're doing your part, they charge the premium to everyone to make up for folks who aren't. And really, the PBGC isn't an optional thing. Most plans, they say you're going to be covered unless you meet the criteria to be exempt, which basically means you're a professional service employer with less than 26 participants, or you're a plan that only covers substantial owners, so a husband-wife plan. Regardless of what industry they're in, they don't have any employees that aren't more than 50% owners, so they would be exempt from the PBGC coverage. You can apply for an exemption, but essentially you've got to meet a list of criteria to be exempt. Otherwise, you're going to be covered. So in our land, where a lot of cash balance plans make sense for owner-held companies, where it's the owner and spouse only, those plans are not going to be covered by the PBGC. So administratively, it's easier because they don't have an annual filing, but they're going to be the ones that are subject to maybe a lower profit sharing contribution while they're max funding the cash balance plan. But a lot of your cash balance plans out there are going to be more than 25 participants, or they're not going to be professional service employers, and then they are going to be PBGC covered. And so then you get the regular 25% deduction limit.